Welcome to the Thursday edition of Tech Stocks Daily. Today, we're diving deep into Apple's $24.2 billion services surge and potential AI paywalls. Why is Warren Buffett trimming his Apple stake? Then, Shopify's stellar Q2 results have Wall Street buzzing, but the options market is throwing caution to the wind. Duolingo skyrockets with growth and stock swings, plus juicy acquisition rumors. Lastly, CrowdStrike stumbles with a class action lawsuit leading to echoing stock drops. Stay tuned to get all the inside scoops on the tech stocks you can't afford to ignore. Gather round, tech aficionados, and lock in on the latest buzz from our favorite trillion-dollar fruit company, Apple. That's right, the Cupertino giant is back in the spotlight for not just one, but a triple whammy of intriguing updates. Buckle up, because we're diving deep into what's making headlines today. First off, let's unpack a tantalizing tidbit about Apple that you might not have fully grasped. You see, Apple has this magical moat known as its services segment, a juggernaut that raked in a staggering $24.2 billion in Q3 of fiscal 2024. This makes up a hefty 28% of the company's total revenue. A decade ago, this figure stood at a humble $4.5 billion, which means Apple's services have truly leveled up in a major way. From AppleCare to iCloud, Apple Music to App Store commissions, these revenue streams keep the Apple ecosystem both sticky and lucrative. The latest evolution? Apple Intelligence, a fancy new take on AI, aiming to make every Apple device so indispensable, you might just start referring to Siri as your BFF. This AI initiative appears to be Apple's golden ticket, as it seeks to further integrate itself into every nook and cranny of our lives. Now here's where things get even juicier. A top analyst has suggested that Apple might soon add a paywall for advanced AI features. Imagine, up to $20 extra for premium functionalities that enhance your Siri interactions and photo editing experience. While this move could bolster Apple's already thriving services revenue, it places them in stark contrast with rivals like Google and Samsung, who are offering similar AI perks for, wait for it, free. Google's Pixel phones, for instance, feature AI enhancements like Magic Editor and Magic Compose without an additional charge. So, could this pricing strategy backfire on Apple, or will its die-hard loyalists embrace it as they have many times before? Only time will tell. But hold your iPhones tight, because here's the curveball. Warren Buffett's Berkshire Hathaway has recently sold off almost half its stake in Apple. Yikes! From a colossal $173 billion in market value down to a little over $84 billion, why is the Oracle of Omaha trimming his love affair with the Mac maker? Although Buffett remains tight-lipped, analysts are speculating a rebalancing act to mitigate risk. After all, even a titan like Apple isn't immune to market fluctuations. This move has led to a significant contraction in the overall Berkshire portfolio, which now holds less than $285 billion in total assets, down from nearly $354 billion 6 months ago. Does this mean Buffett's losing faith in Apple? Not necessarily. Adaptivity and performance recalibration are the names of the game here. So, what does all this mean for us mere mortals? In a nutshell, Apple's continued expansion into services signifies long-term potential for growth and resilience, even if Big Daddy Buffett is offloading chunks of his shares. On the horizon, we might expect an uptick in innovation, albeit with potential price tags and market shifts. Keep those Apple gadgets close and stay tuned, because this tech titan isn't done making waves just yet. Stay geeky, my friends. Hey tech lovers, today we're diving deep into Shopify, which has been making waves on the NASDAQ. The e-commerce giant is buzzing in the news for several reasons that might just make you rethink your portfolio. Buckle up, because we've got a mix of earnings bonanzas, market reactions, and even some juicy whispers from the options arena. First up, let's talk about Shopify's dazzling Q2 performance. Shopify reported its second quarter earnings, and oh boy, did they deliver. Adjusted earnings were 26 cents per share, beating the Zacks consensus estimate by 30% and soaring 85.7% over the previous year. Revenue jumped 20.7% year over year to $2.5 billion, capping off a solid quarter, and blew past the Zacks consensus estimate by 2.3%. Even after offloading its logistics business, revenue growth stood tall at 25%. The depth of this success stems from several segments within Shopify. Subscription solutions saw a revenue spike of 26.8% year over year, thanks to a raft of new merchants and pricing tweaks for existing ones. Merchant Solutions also flexed its muscles, showing an 18.6% uptick driven by impressive gross merchandise volume growth, which itself leapt 22% to hit $67.2 billion. From new merchant accrual to burgeoning international markets, Shopify's all-encompassing strategy is clearly paying off. But hold on to your stocks, because that's not all. The options market has been a hotbed of activity around Shopify, indicating that major investors have more in store. Benzinga's options scanner caught a whopping 26 unusual options activities, featuring a noteworthy bias towards bearishness, 57% to be exact, while 38% remain bullish. With prominent puts totaling $298,230 in comparison to calls building up to $174,437, the options behavior hints that hefty market players are bracing for some price fluctuations. What adds more spice is the price window they've been eyeing, $45 to $85, which rekindles interest in Shopify's financial gymnastics from various quarters. Now let's talk future gazing. Despite these mixed signals from the options market, Analysts are, dare I say, mostly optimistic following the Q2 earnings extravaganza. Morgan Stanley's Keith Weiss rolled out an overweight rating, jacking the price target up to $85. Truist Securities' Terry Tillman gave it a hold, but improved the target from $55 to $65. CFO Jeff Hoffmeister summed it up best by saying Shopify continues to rake in growth, even in a mixed consumer spend environment. In conclusion, Shopify isn't just holding firm, it's striding ahead. Whether you're an investor, a tech enthusiast, or someone just looking out for trends, Shopify's recent Newspack Day shows a company that capitalizes on both its expanding services and evolving market strategies. Stay tuned, Shopaholics, because this e-commerce powerhouse isn't done making headlines just yet. So there you have it. Shopify's been the star of the stock market, thanks to its blasting Q2 earnings and buzzworthy options trades. Keep those eyes peeled as we continue to chart this e-commerce titan's thrilling journey. Hey tech fans, we've got a hot and spicy Duolingo update today, and it's as juicy as a plate of nachos with extra guac. Let's dive into why Duolingo was all over the news. First up, Duolingo had a bit of a roller coaster in July, with its stock taking a nosedive by nearly 18%. Investors had a mess stretch with no major news to get excited about, and the S&P 500 wasn't feeling too perky either, marking its worst July in a decade. But just like the cliffhanger ending of a thrilling series, Duolingo pulled off a fantastic rebound in August. Boom. The company dropped its quarterly earnings report on August 7th, and it was like fireworks on New Year's Eve. Here's the lowdown. Duolingo's not just your average language app anymore. The company showcased remarkable growth in its Q2 2024 financials. We're talking about surpassing 100 million monthly active users. That's doubling up from 2 years ago. Revenue soared to 178 million with a 41% increase year over year, largely propelled by an impressive 52% growth in paid subscribers. And oh, did someone say cha-ching? Free cash flow also swelled up to nearly $55 million compared to $34 million last year. Duolingo's acquiring more than vocabulary skills. They snagged the animation studio Hobbes. While this move didn't give stocks a caffeine jolt in July, it's a strategic play. Better animations mean a more engaging and fun user experience. If you're going to be stuck conjugating verbs and mastering tenses, might as well be entertained, right? Switching gears to some serious Wall Street vibes, there's a bit of buzz among heavy-hitting investors. Our folks over at Benzinga took a deep dive into Duolingo's options trading activities, which showed that some big fish have been making moves. Notably, the spread is mixed, 33% bullish, 50% bearish, with 7 puts totaling nearly 318 and 5 calls stacking up 443,381. Some believe Duolingo's price will dance between $145 to $230. Now don't go all in without doing your homework first. Options trading is not for the faint-hearted. And the icing on this language learning cake? On Thursday, Duolingo's stock skyrocketed 10% after it absolutely crushed Wall Street's expectations for Q2. We're talking profit figures of 51 cents per share against the expected 32 cents. And if that's not mind-blowing, sales pumped up to $178.3 million, outpacing forecasts by a cool $1.2 million. Not only did subscription bookings grow faster than sales at 47%, but with 8 million paying subscribers, there's an ocean of 92 million free users that Duolingo can potentially convert. So, is Duolingo still a hot stock to grab? Many think yes. With a burgeoning user base, enticing projections for future revenue, and strong free cash flow generation, its price to free cash flow ratio of 35.5 might seem steep, but is justified by its explosive growth rate. That's the news you users need to know about Duolingo today. Watching this space could be as exciting as leveling up in your favorite language course. Till next time, keep learning and stay tech savvy. All right, tech enthusiasts, today's tech news spotlight is all about CrowdStrike. So why is CrowdStrike, a well-known name in the realm of cybersecurity, making headlines today? Let's unpack the details and see what's really going on. First up, we've got a class action lawsuit brewing, courtesy of Levi and Korsinski LLP. They're representing investors in CrowdStrike who might have been duped by some alleged bad behavior. The lawsuit is aiming to recover losses for those who invested in the company between November 29, 2023 and July 29, 2024. The complaint accuses CrowdStrike of issuing false statements about the reliability of their software updates for their flagship Falcon platform. Apparently, some poor testing practices led to catastrophic software updates, resulting in widespread outages and some pretty serious reputational harm. Ouch, but that's not all. Hagens Berman is also chiming in, urging investors who suffered substantial losses to come forward. Their lawsuit highlights some equally concerning issues. CrowdStrike assured everyone that their Falcon platform was the epitome of reliability and sophistication. Yet a botched automatic update led to millions of Windows computers around the globe crashing into the infamous blue screen of death. This fiasco wasn't just an oopsie. It cost Delta Airlines a hefty 6,000 flight cancellations, which is no small potatoes. Unsurprisingly, CrowdStrike's stock plummeted as a result, dropping a staggering 24% since July 18, 2024. And wait, there's more. Faruqi and Faruqi LLP also threw their hat into the ring today. They're rounding up investors who've lost over $100 to join another lawsuit against CrowdStrike. They're alleging similar grievances: improper software update procedures, and inadequate testing that led to those massive outages and subsequent plummeting stock prices. On top of that, the fallout even called for a congressional testimony from CrowdStrike's CEO. Cue dramatic music. Now, the big wigs at these law firms argue that the company's reassurances were nothing but moonshine, which spurred on some seriously inflated stock prices, only for reality to hit hard. Consequently, analysts from Guggenheim and BTIG downgraded CrowdStrike's stock rating. These details paint a pretty grim picture of what appeared to be rock-solid cybersecurity software, tarnished by poor quality control practices. So, what does this mean for the future of CrowdStrike? As these lawsuits develop, it could influence the company's financial health and reputation, not to mention the trust of its existing and potential customers. It's a challenging time for everyone at CrowdStrike, from executives down to their committed team of engineers and customer support. And now, I want to hear from you. What are your thoughts on this debacle? Do you think CrowdStrike can bounce back from this, or is their falcon permanently grounded? Leave your comments below, and let's get the conversation started. 全天候科技圈的信息就在这里。新闻尽在本节目，为您迅实际更新实时动态。No good Fernan, no goodbye. Let us know your thoughts in the comments section. All right, let's dive into the million-dollar question. Should you buy, sell, or hold one of today's spotlight stocks? Let's zero in on Shopify. Given the latest news, I'd be inclined to hold your position for now, and let me break down why. First, let's recap Shopify's dazzling Q2 performance. They blew past earnings expectations with adjusted earnings at 26 cents per share and revenue soaring 20.7% year over year to $2.5 billion. And that's after shedding their logistics business. They aren't just treading water, they are swimming laps around their competitors. Subscription Solutions revenue spiked 26.8% from new merchants and pricing tweaks, and Merchant Solutions flexed with an 18.6% increase. Their gross merchandise volume skyrocketed 22% to $67.2 billion. That's serious firepower. But hold on to your smartphones, let's not get too carried away. The options market reveals some cautious vibes with 26 unusual activities featuring a bearish bias. Many big players believe that Shopify's price will float between $45 and $85. That's a reflection of possible volatility amid changing market conditions. On the bright side, analysts are throwing a lot of optimism Shopify's way. Morgan Stanley's Keith Weiss rolled out an overweight rating with a price target of $85, while Truist Securities' Terry Tillman lifted his target to $65, even maintaining a hold stance. These bullish signals provide a positive outlook. So why a hold? It's all about managing risk and expectation. Shopify's dynamic performance sets a solid foundation, yet the options market caution suggests being prudent about jumping on a buy frenzy. This hold strategy allows you to monitor upcoming earnings and market sentiment before making a more definitive move. Diversifying risk and evaluating deeper market trends can provide fruitful long-term returns. But remember, folks, always do your own research. Dive into financial reports, understand market dynamics, and perhaps even consult a financial advisor. Your investment decisions should reflect your own insights and risk tolerance. So, keep an eye on Shopify, but maybe don't fill up your cart just yet. Happy investing, tech wizards. Wow, what a day in tech. We've seen Apple pioneering in AI, Shopify dazzling us with killer earnings, Duolingo rebounding like a language learning superhero, and CrowdStrike navigating some serious legal turbulence. Exciting times. If you enjoyed today's update, don't forget to smash that like button, subscribe to the channel, and share this video with your fellow tech enthusiasts. Come back tomorrow for another action-packed roundup. Stay tech savvy and keep those notifications on.